Welcome to Talk Tickers. You're with us to cut through the noise of earnings calls and get straight to the actionable insights for experienced investors.
And today we are digging into the Icahn Enterprises LP first quarter 2025 earnings call.
Let's jump right in. What's the headline number?
Well, the main story is a decrease in net asset value, or NAV. It dropped by $336 million compared to the end of last year, Q4 2024.
Okay, $336 million down. What drove that?
Mostly two things. Negative performance within their investment funds, and also the approval and payment of the quarterly distribution. That pulls cash out.
Right, the dividend effect. But wasn't there anything offsetting that drop?
There was, actually. Some positive performance in CVR Energy, that's CVI, and also in their automotive service segment helped cushion the blow a bit.
Okay, let's break that down. CVR Energy.
Yeah, CVI's share price saw a 3% increase during the quarter, plus Icahn bought back about $33 million worth of shares. So combined, that added around $80 million in value.
Got it. And the investment fund specifically, you mentioned negative performance there.
That's right. They experienced roughly an 8.4% decline for the quarter. Management pointed mainly to healthcare investments as the drag there.
Healthcare's been volatile. But is that the full picture right now?
Interestingly, no. They made a point of saying that if you were to mark-to-market the funds, CVI and UAN, another public holding as of the end of last week.
So more up-to-date pricing.
Exactly. Then the overall performance for the quarter to date would actually be modestly positive. So some recovery perhaps after quarter end.
That's a key nuance. What about their cash position? Always important.
Very strong. They ended the quarter with substantial cash, $1.3 billion at the holding company level.
Okay.
And on top of that, another $900 million sitting within the investment funds. So plenty dry powder.
And despite the NAV dip, they kept the distribution.
They did. The board maintained the quarterly distribution at 50 cents per depository unit.
Okay, let's pivot to the operating segments. Energy, you mentioned CVR earlier. How did that whole segment perform on an EBITDA basis?
Not great for Q1. Consolidated EBITDA for the energy segment was actually negative $61 million.
Negative 61. Wow, compared to last year.
Yeah, it's a huge drop from the positive $203 million they posted in Q1 of 2024.
What happened there? That's a significant swing.
The main culprits were, first, the planned major turnaround at the Coffeeville refinery. Those things are costly and disrupt production.
Right. Standard maintenance, but impactful.
Exactly. And second, unfavorable mark-to-market adjustments on their RIN liability. The value of those renewable identification numbers fluctuated against them.
The RIN's volatility. Always a factor for refiners. Any bright spots in energy?
Yes. The fertilizer business actually performed well. They saw stronger prices and good utilization rates, so that provided a partial offset.
And the Coffeeville turnaround, is that done now?
It is. They confirmed it's complete. So the expectation now is for that refinery to get back to generating positive cash flow.
Good news there. Okay, let's move to the automotive segment. Still sounds like a work in progress.
It does. Performance continues to lag year over year. Sales were down 9%.
9%? Ouch.
Or, well, 6% if you exclude the parts business they divested. Still, adjusted EBITDA for automotive was negative $6 million.
So, still losing money there. What's the strategy? Just wait it out.
No, they're actively investing, pouring money into labor, inventory, equipment, updating facilities, marketing, the whole 9 yards.
Trying to buy future growth, basically.
That seems to be the plan, except some short-term pain for hopefully long-term profitability. They did mention seeing some early positive signs towards the end of the quarter.
Like what?
Things like car count, tire volumes, and overall revenue trends started ticking up as the quarter went on, so maybe the beginning of a turn.
And they're also shaking up the store footprint, right?
Yes, optimizing the portfolio. They closed 24 underperforming locations in Q1.
Okay.
But they're also expanding where it makes sense. They signed a contract for 15 new spots on military bases, for example.
Interesting. So closing some, opening others. What about the closed stores? Just liabilities now.
Apparently not entirely. They mentioned having about 60 properties under letters of intent for potential leasing.
Oh, so trying to monetize the real estate.
Seems like it. And they even said some closed stores were sold for more than their real estate value because someone wanted to operate a business there. So maybe finding opportunistic value even in the closures.
Okay, let's quickly touch on the other segments. Real estate.
Adjusted EBITDA there decreased by just $1 million compared to last year. Not a huge move.
Why the small dip?
It sounds like inventory at their legacy country club project is getting pretty limited now. They expect it to be sold out by 2027.
So winding down one project, anything new coming online?
Yeah, they anticipate more single-family home sales from their newest country club development. Reservations for that are expected to start later this year, end of 2025.
And any property sales, I feel like that comes up sometimes.
It does. They mentioned a potential sale they'd discussed before is now expected to close this quarter. And they're exploring other property sales too.
Food packaging, you mentioned a drop there earlier.
Yes, adjusted EBITDA was down $6 million year over year.
What drove that?
A few things: lower prices, some manufacturing inefficiencies creeping in, and higher material costs hitting them.
How are they addressing that?
They've launched a restructuring plan. It involved consolidating 2 facilities in North America and adding a new state-of-the-art manufacturing line.
Aiming for better efficiency.
Exactly. They expect that to boost efficiency and margins starting in the second half of 2025.
Okay. And quickly, home fashion and pharma.
Home fashion saw a tiny $1 million decrease in adjusted EBITDA, mostly just due to product mix changes.
Pretty stable then. Pharma.
Adjusted EBITDA down $3 million there. That was primarily driven by higher R&D spending investing in the pipeline.
Makes sense.
And also increased sales and marketing costs for a recent global product launch, KUKA.
Right, launch costs.
Yeah.
Okay, let's pull back a bit. We've gone through the numbers, the segments. What are the key takeaways for an investor trying to understand Icahn right now?
But look, the first quarter definitely shows a company dealing with some complexities. The NAV decrease, especially with that hit from healthcare in the funds, really highlights how market volatility impacts them.
But you mentioned that potential quick rebound in the mark-to-market view.
Exactly. That suggests there might be some resilience or maybe just potential for near-term recovery that the Q1 snapshot doesn't fully capture. It shows how quickly things can shift.
And the energy segment.
That really underscores the inherent volatility in refining, turnarounds, RIN prices. It's a tough business. But the key thing now is that the Coffeeville turnaround is complete. So watching its cash flow generation rebound will be critical.
And the RIN liability itself is still out there, right?
Okay.
That $438 million number.
It is. There's some, maybe hope, that the current administration might resolve some long-standing litigation around small refinery exemptions. If that happened, it could potentially wipe out that liability. But that's still an uncertainty.
Definitely something to monitor. What about automotive?
Yeah, the underperformance is obviously a concern in the short term, but you have to weigh that against the fact that they are actively investing and restructuring.
So execution risk, but potential upside.
Precisely. Those early positive signs they mentioned need to turn into a sustained trend. And the way they're managing the closed stores, looking for opportunities, is maybe a positive signal about management's approach.
And then there are those specific investment insights they gave.
Right. The deep dives into companies like AAP and SWIX, the utilities. The commentary about AAP benefiting from AI data center electricity demand is particularly interesting. That's a big narrative right now.
Tying to a major growth theme.
Definitely. And also Caesars highlighting the management, the real estate value, the digital growth, and the buybacks. These provide specific avenues where they see value creation potential within the portfolio.
And the restructuring in food packaging.
Yeah, that shows they're not just sitting on underperforming assets. They're taking steps, albeit with a lag before results show up, to fix profitability issues.
And through all this, they maintain the dividend.
Which signals, at least some confidence from the board about the future ability to generate cash to support it, despite the quarterly NAV dip.
Okay, that sets the stage nicely. Now let's shift gears to our favorite segment. This is not financial advice. Time for some outrageous but plausible trade ideas based on this call. Your first one.
All right, so management sounded pretty bullish on AAP, right? The utility benefiting from AI data center load growth, potential regulatory improvements.
Yeah, definitely a key theme.
So here's the outrageous but plausible idea. Instead of just looking at AAP, maybe consider a long position in a competitor utility or even just an adjacent one that operates in a similar regulatory environment or geographic area that's also likely to see significant data center build out.
Kind of a sympathy play.
Exactly. The outrageous part is you're betting on a sector re-rating or a similar benefit before AAP fully proves out the thesis, playing the broader AI infrastructure narrative through a different, maybe less obvious name.
Riding the wave indirectly. Okay, I like it.
Yeah.
What's your second outrageous but plausible idea?
Okay, this one focuses on the automotive segment's turnaround. We heard about the restructuring, the investments, the store optimization.
And those early green shoots they mentioned.
Right, and also how they're actively managing the real estate from closed stores. So the idea is consider a long position, maybe in distressed debt or perhaps preferred equity, of a major auto parts supplier.
A supplier. Why?
Well, choose one that's been beaten down due to general retail worries, but could benefit if automotive service demand picks up, maybe driven by the aging car park everyone talks about, and potentially by Icahn getting its act together and driving more traffic through its improved footprint.
So you're betting on a recovery in the whole service ecosystem, leveraged through a supplier.
Yeah, the outrageous bit is it's a leveraged bet on a recovery in a sector that still faces challenges, and you're relying partly on Icahn's turnaround contributing to that broader uplift for suppliers. It's a bit of a bank shot.
Definitely requires a few things to go right. Hence, plausible, but outrageous. Okay, good ones. And that wraps up our deep dive into the Icahn Enterprises LP first quarter 2025 earnings call. We pulled out the key results, the strategic thinking, and hopefully some food for thought.
Absolutely. But remember, we have to say it. This is purely for informational purposes. It is definitely not financial advice. Always do your own thorough research before making any investment decisions.
We always appreciate hearing from you. What stood out in this analysis? Did anything surprise you? Any questions still lingering? Let us know.
And be sure to join us next time on Talk Tickers, where we'll dissect another important earnings call.